June 4th, 2026. The night before, one company, Broadcom, had told Wall Street its AI chips would bring in $16 billion this quarter instead of the $17.2 billion analysts had penciled in. A $1.2 billion disappointment. By the closing bell, $1.3 trillion of market value is gone. Not from Broadcom, from everyone, Nvidia, the memory makers, an entire stock index, and Seoul. A miss, amplified 1,000 times over. That amplifier has a name. It was built deal by deal in plain sight, and once you see it, you cannot unsee it. Here's the puzzle. A healthy market absorbs a small miss, this one convulsed, because underneath the AI boom sits a structure most people have never looked at directly. The same handful of companies have become each other's customers, suppliers, landlords, and shareholders all at the same time. Money inside this economy doesn't flow from buyers to sellers and out. It goes in a circle, and a circle carries shocks in both directions, so follow $1 around the ring. Nvidia announces it will invest up to $100 billion in OpenAI. OpenAI takes that promise and signs a $300 billion cloud contract with Oracle, and Oracle takes that contract, borrows against it, and spends tens of billions of it on Nvidia's chips. Watch what the dollar just did. It left Nvidia as an investment. It traveled the circle, and it came home as revenue. Same dollar, wearing a new name. Every company on the route booked something that looks wonderful, and not one of those bookings needed a single customer outside the loop. That's the toy version. The real 2026 ring has more stations. OpenAI has signed for $300 billion of Oracle's cloud, $250 billion of Microsoft's, $350 billion of custom silicon from Broadcom. Nvidia dangles its $100 billion invitation over the middle. And on the far side of the ring, Oracle and Microsoft pay Nvidia for the chips that fill those data centers. Every arrow here is a real, signed, public agreement. Add the promises up, and this one circle carries well over $1 trillion, riding on essentially 5 balance sheets. 5 balance sheets that now rise together, which means they can also fall together. And the receipts only get stranger the further down you read. AMD wanted OpenAI's business so badly, it handed its customer a warrant for roughly 10% of AMD itself. 160 million shares priced at 1 cent each. It liked that structure so much it copy-pasted the deal for Meta. Microsoft and Nvidia together put up to $15 billion into Anthropic. Anthropic then committed $30 billion right back to Microsoft's cloud, which runs on Nvidia's chips. Money out, bigger money back, and everyone's growth chart points up. Wall Street used to call this vendor financing. The industry prefers a warmer word, partnership. Let's be precise about what this is, because nobody in this circle is lying. The chips are real. The data centers are real. Every dollar is real, but a dollar that returns to its own sender proves much less than a dollar that arrives from outside. The loop doesn't manufacture demand. It manufactures confidence about demand, and it books that confidence as revenue. Now hold the two numbers of this story side by side. On one side, OpenAI's signed compute commitments, about $1.4 trillion over 8 years. On the other side, its current revenue, roughly $25 billion a year. The tall block is a promise. The thin sliver is what actually comes in per year. Divide them. The commitments equal 56 years of today's revenue, and the plan is to pay for them inside 8. Silicon Valley calls that ambition. An accountant would call it exposure. And the people closest to the numbers have started saying the quiet part in meetings. In February, OpenAI told investors to expect roughly $600 billion of spending by 2030, a far smaller figure than the headlines. By April, the Wall Street Journal reported that OpenAI's own chief financial officer had pushed to slow the pace of commitments her CEO kept signing. When the loop's architects start debating what the loop can carry, pay attention. Step back and watch how fast this whole structure went up and how fast it started to creak. September 2025, Nvidia unveils the $100 billion OpenAI plan. October, AMD signs away its 10% warrant. November, Sam Altman says the words 1.4 trillion, and the Microsoft, Nvidia, Anthropic triangle is wired the very same week. February. Jensen Huang clarifies that the $100 billion was, quote, never a commitment, an invitation. April. The chief financial officer's doubts reach the front page. June 4th. One modest forecast shakes the entire ring. From groundbreaking to wobble in 9 months. Structures that go up that fast usually skip a few inspections. If this all rhymes with something, it should. In the year 2000, the telecom equipment makers financed their own customers too. Lucent alone committed over $8 billion in loans so that buyers could afford Lucent gear. Nvidia's stakes in its own customer base now top $100 billion relative to its revenue, roughly triple Lucent's exposure at the peak, but the differences matter just as much. Back then, the borrowers were debt-fueled startups that mostly died. Today's buyers are the richest cash machines in corporate history. Then, the market paid over 200 times earnings. Nvidia trades near 40. So, no, history is not repeating. It's doing something more useful. It's testing the same weak point twice. And what happened to the company at the center of the last loop? Cisco, the Nvidia of its day, lost about 80% of its value and then needed 25 years to see its old share price again. It finally got back to even last December, lifted, with no apparent sense of irony, by the AI boom. So remember what the downside actually looked like. The punishment for circular optimism wasn't bankruptcy. It was decades spent underwater. Here's the genuinely uncomfortable part. If you ran any one of these companies, you would sign the same deals. Locking up scarce chips protects your roadmap. Investing in your biggest customer keeps their workloads on your platform. Financing the build-out de-risks the exact capacity your future depends on. Inside each boardroom, every single move is rational. That's what makes this worth studying. Bubbles are not built by fools. They're built by intelligent people making locally correct decisions that add up to something dangerous. But rational wiring carries a systemic price, and June 4th was the demonstration. Tie every balance sheet to every other one, and a single company's bad day becomes everybody's problem. One node misses its forecast. Investors instantly reprice every neighbor on the ring. The cross-holdings shrink, so the commitments they secure suddenly look heavier. The growth story slows, which triggers selling, and the selling triggers more selling. The very loop that amplified the boom on the way up amplifies the doubt on the way down. Same wiring, opposite current. Now run the tape of June 4th on the ring and watch the current reverse. Broadcom guides low, its station dims. Within hours, the doubt travels every arc of the circle. Nvidia sheds $300 billion of market value. The Nasdaq drops more than 4%. And on the far side of the planet, Korea's Kospi, an index packed with memory chip makers, crashes 9% and briefly stops trading altogether. Nobody in Seoul missed a forecast that week. They were simply standing on the same circle. Now the bulls have a case here, and it is not a stupid one. The dot-com loop financed customers who had no money. This loop is anchored by 4 companies that generated $450 billion of operating cash flow in a single year. The fiber of 2000 sat dark for a decade. These chips are sold out years ahead, and the product has real paying customers, $25 billion a year at OpenAI alone, still climbing steeply. A bubble needs a lie somewhere, and nobody has caught this one lying yet. So why should you care if you've never bought a single AI share? Look closer at what you already own. The 10 biggest stocks are now roughly 40% of the S&P 500. Concentration without precedent in the modern index. If you hold an index fund, a pension, any retirement account, you are standing inside this circle whether you chose it or not. The loop's balance sheets are no longer just wired to each other. They are wired quietly to yours. And that is the consequence nobody prices in. Circular deals don't just recycle money. They concentrate correlation. They take 1,000 independent bets on the future and quietly solder them into a single one, which is why a $1.2 billion miss could vaporize $1 trillion. The market wasn't really reacting to Broadcom that day. For one afternoon, it was looking at the solder. So here's my honest question for you. What would it actually take to convince you this loop is solid? A number? A product? A profit? For me, it's the day more money arrives from outside the circle than orbits within it. That's when the story changes. Type yours below. I read all of it. And the next time $1 trillion evaporates over one small forecast, you won't have to wonder what happened. You'll know exactly which wire it traveled.